There is a particular kind of money that most people never talk about, not because it is rare, not because it requires privilege or a graduate degree or a family with generational wealth. They do not talk about it because it does not feel like money at all, not at first. It moves too quietly. It does not arrive with urgency. It does not demand attention. And in a world that has taught most of us to associate money with speed, with hustle, with visible results, slow money feels like an afterthought. This video is about what happens when someone sits with that afterthought long enough to realize it was never an afterthought at all. Danielle was 26 when she first set up the automatic transfer. She was living in Cincinnati at the time, renting a 2-bedroom apartment with a college friend, working a mid-level coordinator role at a logistics company. Her salary was not exceptional, $43,000 a year before taxes. After rent, after utilities, after the car payment and the phone bill and the student loan minimum, she had maybe $300 of breathing room each month, sometimes less. The kind of breathing room where one unexpected expense, a car repair, a medical copay, a friend's destination wedding you do not feel able to skip, can make the whole month feel like a miscalculation. She had read something, not a book, not a formal course, just a blog post that someone had shared in a group chat about index funds, about putting money in and leaving it alone. The post had a table showing what happened to $200 a month over 20, 30, 40 years. The numbers were big by the end. She had seen tables like this before. Most people have. They glance at them, feel briefly motivated, then return to the urgency of the present. Danielle did something slightly different. She did not make a big decision. She did not restructure her finances. She transferred $80 into a brokerage account, set it to repeat automatically on the 15th of each month, and then, for the most part, she stopped thinking about it. That distinction matters more than it sounds. The thing about slow money is that it does not reward attention the way other financial strategies do. If you're trading individual stocks, attention is the product. You check the price, you read the news, you feel the tension of being in the market every single day. That feeling is information. It tells you whether you made a good call. It gives you a story about yourself as someone who is active, engaged, responsive. Slow money refuses that story. $80 disappearing into an index fund on the 15th of every month does not create a feedback loop. There is no notification, no moment of confirmation, nothing to post about. For someone like Danielle, who had been raised to associate financial progress with visible signs of financial progress, the silence was almost uncomfortable. For the first 6 months, she checked the account approximately every 3 weeks. The balance moved in small, seemingly random directions. Some months it was up $30 from contributions and market movement. Some months it was down $40 because the market had a bad week. None of it felt meaningful. She told a coworker about it once, a woman named Priya who had been at the company longer and had a finance background. Priya asked how much she had put in. Danielle said a little under $500 so far. Priya nodded and said, "The math doesn't work at the beginning, it works at the end." She did not explain further, and Danielle did not ask, but she kept the automatic transfer running. What Priya was gesturing at is something most personal finance content fails to communicate with any real accuracy. The growth in an investment account is not linear, it is exponential, but exponential in a way that is psychologically invisible for the first several years. The official term is compound interest, or compound growth when applied to equity returns, and it has been explained in almost every personal finance article ever written. But the explanation usually comes with a chart, a number, a projected total, and then a confident assertion that this is powerful, that this changes everything. What the charts do not show is the psychological experience of the early years, which is genuinely, structurally unremarkable.
Here is what the math actually looks like, not as a motivational device, but as a description of reality. If Danielle puts in $80 a month and her account earns an average of 8% annually, which is roughly in line with the historical average of a broad U.S. stock index over long periods, after 1 year, she has approximately $1,004. That is her $960 of contributions plus roughly $44 of growth. That does not feel like transformation. After 3 years, she has around $3,200. After 5 years, around $5,800. Still modest, still the kind of number that is easy to dismiss, but something shifts around year 8, year 9, year 10.
The returns are no longer being applied to small numbers. They are being applied to larger and larger balances. And each year, the growth itself becomes a meaningful contributor. By year 15, with the same $80 a month and the same 8% average, she is looking at something closer to $27,000. By year 20, over $42,000. The last 5 years of that 20-year period will generate more growth than the first 12 years combined, not because anything changed, but because time had been compounding quietly the entire time. That is not a metaphor. That is the arithmetic. Here's the thing about Danielle's story that the arithmetic alone cannot explain. Somewhere around the second year of doing this, something shifted in how she thought about her money. Not dramatically, not in a way she could have articulated at the time, but slowly the presence of that account, even small and largely static, began to change the texture of her financial decisions. She started to see expenses slightly differently. Not as moral failures or successes, not as the language of deprivation that a lot of financial advice accidentally promotes, but as trade-offs that were, in a very concrete sense, in competition with a future version of her account balance. A researcher at a behavioral economics lab in Boston, whose work touches on exactly this phenomenon, describes what she calls the slow saver effect, which is a shift in psychological framing that tends to occur not when someone starts investing, but roughly 12 to 18 months after they start investing, when the habit has become automated enough that it recedes from active decision-making and begins to function more like a background financial identity. What her research suggests is that the act of consistently contributing to a long-term account, even in small amounts, begins to restructure how a person categorizes money in their working memory. Money becomes less about what it can do right now and more about what it is already doing. The present and future versions of money feel less separate. For Danielle, this showed up in practical, sometimes almost mundane ways. She noticed that when she had an impulse purchase she was uncertain about, she began to do a loose, informal comparison, not the rigid dollar-for-dollar calculation that some financial advice promotes, but something more intuitive. A $200 jacket was not just $200. It was also, she found herself thinking without consciously choosing to, the same amount as 2.5 months of contributions to an account that was slowly becoming a real number. That reframing was not born from discipline, it was born from proximity. She had been watching, however distantly, what slow money does over time. This is the thing that takes the longest to understand and the least amount of effort to implement, which is why it remains underutilized. Most wealth-building frameworks ask for optimization at the beginning. They ask you to calculate your net worth, track every expense, find the highest yield account, front-load your contributions, build a multi-bucket system. These things have genuine value, but they also require a degree of psychological bandwidth that most people navigating median incomes and real financial stress simply do not have available. The slow money approach asks for something different. It asks for consistency without optimization. Put something in, Automate it and accept that it will feel insufficient and invisible for longer than you're comfortable with. The discomfort of that invisibility is not incidental. It is the mechanism. The account is growing while you are not watching it, and the habit of not watching it, of allowing it to exist outside your daily financial anxiety, is itself part of what makes it work. High-frequency engagement with your investments tends to produce worse outcomes. This is not a philosophical observation. It is an empirical finding repeated across enough studies of retail investor behavior that it has become one of the more consistent results in behavioral finance. People who check their accounts more often tend to react more, sell during downturns, re-enter at peaks, and underperform the very funds they are investing in. The S&P 500 has returned an average of around 10% annually over the long run. The average retail investor in U.S. equity funds has historically captured significantly less than that, often 4 to 6%, because they exit and re-enter based on feeling rather than structure. Slow money is in part a psychological workaround for your own reactivity. By the time Danielle was 32, her account had grown to just under $22,000. She had never dramatically increased her contributions, though she had raised them modestly a couple of times when her salary increased. She had not, in any conventional sense, sacrificed. She had not given up vacations or meals out or the occasional indulgence. The money had accumulated in the background, the way a savings account grows when you are not depleting it, except with the added variable of compound growth pulling it forward. She called Priya one evening, the same coworker from years earlier who had since moved to a different firm. She mentioned the balance, not boastfully, more with a kind of surprised recognition. Priya said something that stayed with her. She said, "The balance is not the thing you earned. The thing you earned is that you stopped needing to feel it to know it was there." She meant something specific by that. The financial outcome and the psychological outcome had separated. Most people want the money to feel like something at every stage. They want the validation at month 6, at year 2, at year 3. Slow money does not provide that. What it provides instead is a gradual rewiring of the relationship between present action and future consequence, which turns out to be one of the more durable shifts a person can make in how they move through a financially complex world. None of this means slow money is the only answer, or that $80 a month resolves structural inequity, or that someone with $30,000 in credit card debt at 22% interest should be directing any available cash into equities. Context always exists. The math works within conditions, not outside them. And there are people for whom the margin is genuinely too thin, for whom $300 of breathing room at the end of the month is already the good version of the month. But for the many people who sit somewhere in the middle, who have some discretionary room but have never quite found the entry point that felt psychologically manageable, the slow money framework offers something unusual. It does not require you to believe you're going to be wealthy. It doesn't require you to feel optimistic about the economy or confident about the future. It requires only that you set up a transfer, automate it, and resist the urge to turn the visibility back on every time you feel uncertain. The account will do the rest, not because money is magical, but because time is the one variable in the compound growth equation that costs you nothing to provide. Danielle still has the account. The balance is different now than it was at 26. The automatic transfer still runs on the 15th. She does not check it every 3 weeks anymore. She checks it maybe twice a year, the way you might check on something you trust to keep moving without supervision. The money is not loud. It is not urgent. It is not the kind of wealth that announces itself. It is the slower, quieter kind, the kind that takes so long to become visible that by the time you look directly at it, it has already been there for years. I'm Maya. This is Money She Spills channel, and you're officially too smart to be broke. Subscribe to my channel. See ya.